Hi, friends. Hopefully, this will be the last video because there's this one last topic that remains, and that is about the DuPont analysis. So, if you remember, there was one ratio that we previously did from the profitability ratios category, and its name was return on equity. And its formula was actually quite straightforward, which was the net earnings, net income divided by the equity. So if let's say this is the income statement of the company, and you want to calculate the return on equity, this was the formula that we used. We took the net income and we divided by the equity. In this case, the net income is right here, the last line item of the income statement, and equity comes from the balance sheet. So we just take these two, we divide them, and we get the return on equity. Usually it is coded in percentage. So there you go. This is about 13.10%. And it's easy to calculate. But what we're doing in this case is there's another way to calculate it. We take the net income, we divide it by sales. Then we take sales and we divide sales by asset. And then we take the assets and we divide the assets by equity, which means that all of these cancel each other out, right? Because if we multiply these three separate ratios, the sales will cancel out this, and this asset thing will cancel out this. So we will be left with net income divided by equity, which was the original formula. So a natural question would be, why do we have to do it? If we end up with the same thing, what's the point of going through this long route? Well, the answer to this is that these three separate ratios actually give us a separate way of looking at the company, right? Because these three ratios are meaningful in different ways. So if we were to calculate it this way, we'll get three different ratios, which let's see, I can't get rid of these lines, so please bear with this. If we calculated return on equity in this way, obviously we're going to get the same answer, which was 13.1%, right? But we, in the meanwhile, while doing this, we get these three separate numbers as well, right? And each of these separate numbers is giving us a different perspective about how the company is doing, particularly this last one. So this last ratio, asset divided by equity, this is called the equity multiplier. It has some importance in a few different ways, because essentially what does the equity multiplier mean? If somebody has, let me try to use the whiteboard. So if someone has got assets in their company, so assets are worth 100, and out of those 100, we try to know how many are coming from borrowings. Let's say 90% of the money is coming from borrowings, while only 10% is the equity part, right? So I can type here as well. Yeah, I can use the pen. Yes, I can. So this is the asset, right? And this is, here you go. This is the debt or the borrowing or the debt part, right? Borrowing or the debt. While this is our equity, or call it ownership, or the equity part. So essentially, if somebody has a company and they have assets worth of $100 million or rupees, but 90% of those assets are funded through borrowings, while only 10% of the money is coming from the owner's money or some investors' money, then that means that this company has to make a lot of repayments, right? Which may not be a very good thing to do, right? Or which may not be a very good business model. So in this case, the asset divided by equity, right, is going to be very, very high. This equity multiplier will be very high if the ownership part is very low. So that is not what we want, right? But if that is the case, then it can easily exacerbate the size of the return on equity, because if this thing becomes very huge, this asset divided by equity becomes very huge, then the return on equity will also become very huge, regardless of whatever is going on in the rest of the company. So regardless of whether the company has very good income or regardless of the size of the sales, even if these two are very small, only the borrowings will increase the size of the return on equity ratio. For example, in this case, let's just take this one. The company has return on equity of 16.6%, and it had 16.6% in 2020, which is a reasonable number. But the out of the 16.6%, this factor of 2.2 is reasonably large. It is increasing the size of return on equity. And how is it doing it? Just because the company has borrowed a lot of money, this ratio is looking good, but otherwise this ratio might not look so good. So this is the point. This is the reason why we do DuPont analysis, that we just try to understand which element is contributing to the profitability of the company. Right? It may also be true that the company is actually very, very profitable. It may be moderately leverage. By leverage, we mean how much debt the company has piled up. So it may have, let's say, 30% of borrowings. So this proportion, this ratio will not be too high in that case. But the other two may be quite reasonably good, and that makes the return on equity pretty high. That's a good scenario. So the point, again, one more time, when we calculate the return on equity, and if it comes out high or if it comes out like a good ratio, we need to analyze a little bit more because this ratio may be influenced by huge borrowings conducted by the company. So thank you very much, and hopefully this will be the last video.